Hi, welcome to this quick guide of the cash flow statement. Alright, so what's coming up in this video? We're going to do an introduction to and describe some of the benefits of the cash flow statement. Then we're going to go into guides into each section of the cash flow statement, including possible interpretations of particular results. And then we'll go through a couple of examples. We'll go through an example of a direct cash flow statement and then an example of an indirect cash flow statement. Okay, here's an introduction. The cash flow statement is one of the four main financial statements that a businesses produce. So whether that's found in an annual report for a listed organization or your own bookkeeping software or a financial accounting system. So the four main financial statements are the cash flow statement, the balance sheet, the income statement, and the statement of changes in equity. So the cash flow statement is like a video of an organization's financial performance. It's a set of measurements across a set period of time, specifically across an accounting period. So for example, you would have a cash flow statement that describes the financial performance from the 1st of January 2017 to the 31st of December 2017. It lists cash inflows and outflows according to three separate categories. And that's the key idea. It describes the cash inflows and outflows of a business. It will list operating activity cash flows, their respective totals and an overall sum total. And then it'll have investing activities cash flows, their respective totals and an overall sum total. And then finally, the financing activity cash flows, their respective totals and an overall sum total. So there are those three main categories within the cash flow statement: the operating activities, the investing activities, and the financing activities. And all cash flows are broken into one of those three categories. And the overall conclusion is a net change in cash result for the period, which is simply a sum of all the three previous categories. So why do we care about the cash flow statement? Here are some of the benefits of the cash flow statement. Now you have to remember that expenses and liabilities are paid with cash and not profit. Profit is an accounting term. You can't say, I'm going to pay this bill with my profit last month. You have to physically hand over cash. So it's important to know where the cash is coming from and how much cash you have on hand. Cash flows are very important. And also, a business only goes into liquidation or bankruptcy when it runs out of cash, not specifically when it's running losses. They may be not linked or correlated whatsoever. Secondly, dividends and interest are paid with cash and not profit. That's the same sort of concept, but if you're an outside investor that has lent money to the organization and you want your interest, or you've made equity or you've invested equity in the business and you want dividends, then you are interested in cash flows because that's how your dividends and interest is going to be paid. Thirdly, there's cash and accounting policy choice. The cash flow statement gives a unique view into the business because it removes a lot of the different accounting policy choice out of the performance of the business. You'll find the other financial performance statement, the income statement, has a lot of accounting policy choice embedded in the results. So choices like depreciation or how accrued expenses are recognized and so forth. With cash, it's very hard and fast. It's hard to manipulate, hard to change, and it's very, very reliable with cash leaving and coming into the organization. And finally, the cash flow statement gives a good indication of business success and the business life cycle that some of the other statements don't offer. You can tell if cash, where the cash is coming from within the business, where it's leaving, whether it's generating good cash or bad cash. That may seem odd if I say it now, but I'll explain a little bit later, or you'll understand by the end of the video. And also you can tell the business life cycle by where the cash is coming from, whether it's investing, operating, or financing. And that you can tell what stage of the business that the organization is at. So there are a lot of benefits to the cash flow statement. So let's get into the cash flow statement. We're going to work backwards. We're going to go from financing first of all. And financing activity cash flows are cash flows for financing investments or for returning capital. That's a bit of a general term. But basically, it's any cash flows affecting the long-term liability and owner's equity accounts, the people that finance the business. So it talks about how an organization obtained financial resources, specifically cash, and then how the business returned resources to the financier. And some of the examples we have here are debt issuance and retirement, equity issuance and retirement, and dividends paid. So if a business gets a loan from a bank, that's debt issuance. It's got a new loan. It's got external finance from the bank. That'll show up in the financing activities. If a company purchases back some of its own stock, that's equity retirement. It is returning capital to the shareholders, and the shareholders are external financiers. That's part of the financing activity. And dividends paid is also a reward for the shareholders. So what could the results be telling us within the financing activities section? For instance, there could be cash inflows during the startup of the business. So the very first thing that a business normally does is raise capital or raise finance. It's going to fund the new business. So you will see large cash inflows during the startup of the business within the financing activities section. There may be cash outflows during the wind up of the business, and that's just the reverse. So once the business is closed down, it returns all the leftover cash to the banks or to the shareholders just before it closes up. You may see cash inflows during the growth stages of the business. So you'll see many growth companies are trying to access as much capital as possible to fund their expansion. They're growing the business. So they're trying to raise equity or they're trying to issue debt, and they're growing the business, and there'll be lots of cash inflows in the financing activities. There may be cash outflows, which could be an indicator of strong performance. If a business is performing really well and it's got lots of cash on hand, it can reward the shareholders by paying extra dividends, or it might start paying off some of its debt. It's performing well, it'll pay off its debt while the good times are rolling, or it may return some of the capital to shareholders in the form of dividends. Or, on the other hand, cash inflows may be a signal of weak performance. Ultimately, any business, whether it's selling widgets or cars or books, wants to generate most of its cash by selling the widgets or the cars or the books. If it's constantly having to seek out external finance, it might mean that the business isn't performing as well. It's not selling the widgets or the cars or the books, so it keeps on issuing more debt, or it keeps on issuing more shares or stock. So it could be an indicator of weak performance if there are a lot of cash inflows. And that's it for the financing activities. Next up, or the next stage, is the investing activities. And these are the cash flows in purchasing or selling long-term investments. And specifically, they're any cash flows affecting the long-term asset accounts of the business. And ultimately, these are the investments that generate a future return and lay the foundations for the operations. It shows how a business purchased cash-generating assets and also how a business sold the same type of assets. So cash outflows when it purchased long-term assets and cash inflows when it sold those assets. The examples we have here are purchase and sale of property, plant and equipment, the purchase or sale of equity instruments, or even loans made in some sort of long-term investment. So if you look at it like this, a business has raised finance and then it'll start purchasing long-term assets. And these assets will be used to generate a future return in the business. And what could the results be telling us? Well, here's the example that I just explained. There could be cash outflows during the initial setup or tooling of the business. So earlier on we talked about financing activities, the new business raised capital. Now it's got to set up the business with that new capital. So during the initial setup and the tooling, there could be lots of cash outflows. A new business might buy a premises, a new business might purchase a car or a truck, and so forth. There could be cash inflows during the liquidation prior to the wind-up, and this is just the opposite. Once a business has decided it's going to close down, it starts selling off the business. So it liquidates the business. There'll be lots of long-term assets that are sold, and there'll be lots of cash inflows. Another example or another situation could be cash outflows during expansion. Now, generally, most businesses want to expand over time. They want to keep growing their size, keep having larger and larger profits or larger and larger cash inflows, and it needs investments to expand the size of the business. And by expanding the business, they'll be purchasing more and more long-term assets. And they're the cash outflows that will be shown in the investing section, in the investing activities section. And then there's the opposite, cash inflows during contraction or divestments. If a large business sells off a portion of its business to perhaps focus on its core activities, then there'll be, as the long-term assets are sold, there'll be cash inflows when it divests of that part of the business. The third example we have here is cash inflows and outflows during transition. So if a business decides to change strategy, sell different types of products, or even just relocate, there could be a bit of a mix and match between cash inflows and outflows in the investing activities section, as the business restructures, selling off the old long-term assets with the old strategy, and then the outflows as it purchases the new assets for the new strategy. Next up, we have cash outflows during strong performance and cash inflows during weak performance. And this relates to what I said earlier. Ultimately, every business wants to succeed, sell lots of widgets or books or cars, and keep expanding. So if it keeps expanding, keeps growing, keeps being successful, and turning in strong performances, then you may continually see cash outflows in the investing activities as it keeps on buying more and more long-term assets that'll fund the expansion and success of the business. The opposite of this is cash inflows during weak performance. Now, the long-term asset accounts in the investing activities section are the cash generating assets. Now, you can raise cash by selling your long-term assets that could fund other parts of the business and have cash inflows, but in a way that's kind of like selling the farm. You may have to raise, you can't issue any more debt, no one wants to buy your shares, so you might be selling your long-term assets on the market, and these will be cash inflows during investing activities to otherwise fund the operations. And that's the investing activities section. And finally, and probably the most importantly, is the operating activities section. And these are the cash flows in running the day-to-day operations of the business. It's any cash flows affecting the core functions of the business, the cash flows that are involved in selling the business's products. So if it's a bookstore, these would be cash inflows, for example, receipts from customers as it sells books, payments to suppliers as it purchases books, payments for rent to hire the bookstore, payments to employees to work in the bookstore, and taxes paid. It can show you how well, or perhaps how well not, a business implemented its strategy to sell its products. Ultimately, all businesses put everything in place so they can sell their products in the operating activities. Perhaps selling books, how well the strategy was at selling books. And it also shows the cash generation capabilities of the core business that will maintain future operations, repay loans, pay dividends, and fund new investments to grow the business. The best source of any cash for a business is selling its products, the operating activities. Sure, you could sell long-term assets. Sure, you could sell more shares or stock. But the best source of cash, the most long-term source of cash, is selling products to customers. And that forms part of the operating activities. So what could some of the results be telling us? Perhaps growth stages of the business. If you see continually increasing cash flow from operating activities, it could show that the business is growing. So this follows on from that life cycle approach we've been talking about earlier. Firstly, in the financing activities, the business raises finance to fund the business. Then, in the investing activities, it purchases the long-term assets to set up the business. And now, during the growth stages, the cash flow from operating activities is continually increasing as it sets up the business. It's now doing what it's supposed to do. Secondly, if there are stable and high levels of cash flow from operating activities, it may mean the business has reached cash cow status. Generally, business just keeps generating good levels of cash. And finally, it may mean a business is in decline if there are continually decreasing levels of cash flow from operating activities. All businesses have their life cycle, and most businesses, except possibly a few, go into decline eventually, unless they change products or change strategy. And maybe if a business is in decline, it finds it harder and harder to sell its core products, and this will be shown up as decreasing cash flow from operating activities. The second situation we have here is a recent expansion with the expectation of growth. Now you may see there could be a lot more cash outflows in operating activities if the business is expanded. So the business has grown in size, there may be more operating costs, and that'll show you a lot more cash outflows, and then hopefully the business, if the strategy is successful, will grow into that now larger size. There's acquisitions or divestments. Just a matter of scale. If a business doubles in size or halves in size, then you would expect the cash flow from operating activities to double in size or halve in size. There could be business strategy changes, and this will alter the level of cash flow from operating activities. So as the strategy changes, they may be more successful at selling books or widgets, or if they're less successful, there'll be less cash inflows from selling books or widgets. Or if they change from books to selling ebooks, then the level of cash outflows to fund the operating of that business would also change. So business strategy changes can affect the inflows and outflows of the operating activities. And finally, cash inflows during strong performance. This is the best indicator of strong performance. Lots of cash inflows in the operating activity section. That means it's selling lots of products and it's maintaining operating costs well. You want a high level of overall cash flow from operating activities. And you want a low level of cash outflows from operating activities because that may be an indicator of weak performance. If the strategy isn't successful, if the assets aren't correct, then it's not selling a lot of products, having more expenses than sales, and these will be shown as cash outflows from operating activities. Overall cash outflows. There's always going to be cash outflows and always going to be cash inflows because there's always running costs and sales. But over an aggregate level of cash outflows would be an indicator of weak performance. An aggregate level of cash inflows would be an indicator of strong performance. Now there is something worth mentioning. In every type of cash flow statement you look at, the financing and the investing activities are exactly the same. But when it comes to operating activities, there are two different methods that they can be presented in a cash flow statement. There's the direct method of the cash flow statement and the indirect method of the cash flow statement. Now, the same underlying cash flows are shown in both methods, but they're just presented differently in these two different methods. So the cash flow statements look a little different. Now, the direct method has cash flows broken down into classes of transactions, like receipts from customers or payments to suppliers. And the direct method will look similar to the investing and financing activity sections. And the alternative is the indirect method. And this is a reconciliation of net income to cash flow from operating activities to account for non-cash adjustments. So what this one will look like, it'll have the top line will be net income, and then below that will be a number of non-cash adjustments, it'll be net income plus depreciation and amortization plus deferred taxes minus working capital adjustments, different non-cash transactions or adjustments, and if you sum all of those together, you will reach a final total cash flow from operating activities. So it's more of a reconciliation as opposed to having specific classes of transactions that are recorded. Okay, let's go to a couple of simple examples. So here's a basic example of a direct cash flow statement. You've got operating activities at the top, receipts from customers, payments to suppliers, payments to employees, a total of $10,000. Investing activities, they purchased a long-term asset for $20,000. So they're generating cash from their operating activities, which is a good sign. They're investing in new long-term assets, so they're trying to expand. They're not trying to, they may be trying to expand or replace their long-term assets. And when it comes to financing, there are dividends paid. They've paid a $2,000 dividend, which is a good sign. They've issued $40,000 worth of stock or shares, and they've even paid back $10,000 worth of debt. So they've retired $10,000 worth of debt. So they're issuing shares and paying off debt. So they're changing their capital structure. And the overall cash flow from financing activities, they have received $28,000 worth of inflows. And then you have the cash balance, 1st of January 2017, $60,000. The net change in cash, which is $18,000, which is just the operating activities, $10,000. The investing activities minus $20,000, and the financing activities plus $28,000. And that leaves a cash balance of $78,000. So it'll look. That's the stylized example. The larger the business, the more complicated it'll look, but it'll all follow the same sort of structure as that. And here's a simple example of a indirect cash flow statement. Now, the investing and financing activities sections have literally been cut and pasted, so there's no difference there. The only difference is the operating activities section in the indirect statement. So this time we start with a figure of the net income figure from the profit and loss statement. They had a profit of $6,000, and then we add back the depreciation and amortization of $1,500, and then we also add back some other non-cash items of $2,500, and that equals the same cash flow from operating activities section total of $10,000. So the total won't change between the two different statements. It's still the same amount. It's just how it's presented. So it's the same sort of cash flows. It's just how it's presented. And then we have the same net cash balance, same net change in cash, and same end of year cash balance. Okay, that's about it. Let's just review what we covered. So we talked about the cash flow statement. It's like a video across a period of time of the financial performance of a business. It lists cash flows according to operating, investing, and financing activities, which results in a net change in cash. And there are direct and indirect cash flow statements depending on how operating activities are presented or is presented. Okay, that's it. Thanks for your time. That is a quick guide to the cash flow statement. I hope you can give me a thumbs up. Cheers.